Welcome back to the best crypto trading course for beginners. In this video, we're going to be talking all about putting together your trading system. So here's where part 1, 2, and 3 all start to come together. We're going to be talking about the different components of a trading system. And then next week, we're going to be talking about my actual favorite trading strategies. But it's important that you understand part 4, what we're talking about right now, so you understand the components that make up a successful trading strategy. And then part 6, we're going to talk about trading psychology. So let's go ahead and let's dive in here. First things first, when determining your trading system, first things first is you need to determine on which time frame you're going to be trading. Are you going to be a scalper, which you're going to be looking at smaller time frame candles, or are you going to be swing trading, where you're looking at a longer period of time to hold a trade? So let's go ahead and take a look at this. Okay, so somebody that's a swing trader, generally you're going to look at maybe the daily, maybe even the weekly chart. And you may be looking at the 4-hour chart and maybe even like the hourly chart as well. These are kind of longer term trades that you may want to hold anywhere from like maybe over a day to maybe several weeks, if not several months. This is considered swing trading, okay? And the benefits of swing trading is that price definitely moves a lot slower. So you have more time to react and more time to think, which is sometimes nice if you're starting off. And it depends on your schedule. If you don't have times to be at the charts very much, then you may want to consider doing more swing trading type of style. Now, if you are a scalper, maybe you're looking at lower time frames, like you'd come down to maybe like the 15-minute time frame, or you'd come down to the 5-minute time frame. Or even if you're scalping, you come all the way down to like the minute time frame, where it's going to be really, really quick action. You're in and out of the market quickly, and you're very rarely, probably never holding a trade more than like the period of like 1 day. So this would be like intraday trading, or what's called day trading. So these are the different types of trading. So you first have to see which one fits your style better, scalping or swing trading. Now, with that being said, also in regards to timeframes, there's something called multiple time frame analysis, where you may want to use multiple timeframes to get an idea of how you want to trade the market. So let's say that the time frame that we really want to enter on is like the hourly time frame, but we may want to come up to like a higher time frame, either the 4-hour or the daily time frame, to get an idea of what's actually happening with the trend. So if we see that we're on an uptrend here on the daily time frame, then we may only want to take actual buy trades in this sort of market scenario. So when I pop down here, maybe I'm not even looking to trade in the zone because we see that the moving averages show us that it's a downtrend. Maybe we'll only want to be taking trades when we are in an upward trending fashion. So this is called multiple time frame analysis. But you basically want to decide on a single time frame that you're going to enter the trade. The second part of your trading system is to determine the direction, and you're either going to be buying or selling. There's really only two options, right? And in crypto, basically, if we really look at it, it's really only been beneficial to really buy. If you look at any statistics, it's really vastly most beneficial to be buying cryptocurrencies, especially if you're swing trading or holding trades longer, because over the past 10 years or so that the market's been around, it's just steadily kind of climbed up. Sure, we've had boom and bust cycles, but the statistics and the numbers say that you should generally be long. And plus, it's a lot easier to just be long and to buy cryptocurrencies than it is to short the market. You can only do that by trading futures, which you can use on a broker like KuCoin, which I'll include a link below. We talked about that in the first video. Okay, so with determining direction of the trend, again, we talked about this in video 1, but it's really quite easy to see if you just slap on like a fast and a slow EMA. Again, here I have from the previous video where we talked about indicators, I have the 10 and the 50 moving average, and I can see that the 10 is above the 50, and we can see that price is climbing upwards. So generally, I only want to be buying in this sort of scenario. Now, I may wait for price to come back and pull down to like one of these moving averages. Maybe this would be a good time, or maybe pull all the way back down to this moving average, which we saw it did here, before entering a trade, which also might be a really good idea. So first things first is you need to determine your time frame, and then you want to determine which direction you're actually going to be trading. In crypto, more often than not, you're probably trading long. The next thing, which arguably might be one of the most important things, especially if you're a beginner, is determining your risk management system. So what does that mean? Well, that means how much money are you going to risk per trade? And generally, as a rule of thumb, you can risk somewhere between like 1% and 3% of your account on each trade. I know kind of a very average that a lot of people use is around 2% per trade. So that means that when you're going in to decide how much of this crypto am I going to buy, you want to make sure that it's only maybe 1 or 3%. Maybe start with 1% if you're brand new until you develop more confidence in your trading system, which we're going to be talking about at the end of this video. So make sure that you stay tuned. Now, a couple ways to determine risk. One is use a percentage like we talked about, somewhere between 1 and 3%, or you could also decide to trade a dollar amount. Now, how do we determine how much we should actually be trading? Well, you basically are going to have somewhere where you're going to put your exit criteria or where your stop loss will be, where you basically say that this trade is invalidated, and you use that math to determine how big of a position you should buy. The next component of a successful trading system is you have to figure out an entry criteria, but this is only after you determine the time frame, the direction, and you determined what your risk is going to be. Now you want to start talking about the entry trigger. Okay, what's going to signal you to put on a buy or a sell position? Now, there's a lot of different ways that you can enter the market, and I'm not here to tell you the right way to enter or exit the market. I'll talk about my favorite ways in the next video, but make sure you continue watching this video because there's important things that you need to understand in this video before we move to the next one. But with that being said, here's examples of entry criteria. Maybe something that requires an entry criteria is something as simple as the moving averages crossing over. So if you see the fast one crossing over the slow one, then maybe this is an entry criteria for you. Or maybe, say, for example, you want to wait till the market is like oversold to get into the market. So you could see here on the RSI, we know that the market on the daily time frame was trending upwards. So we wait for it to pop below this 30 and wait for it to come back in. And that's where we'd enter the trade. So we'd enter somewhere like around here and you could ride that really nicely like that. Or maybe you just want to get somewhere like close to there. So that's how you may enter on, say, using the RSI. And one other entry criteria that you may use is you may use the Bollinger Bands, which we talked about again in the previous video, or maybe you wait for it to come down to the lower band of the Bollinger Bands and you wait for the green candle to come out of the band, and that's where you'd enter the trade and you can ride it on up. Again, you can see this playing out time and time again. You wait for a green candle to come out right here and then you enter right there, okay? Again, you wait for a green candle pops out of there and you ride it up to the next Bollinger Band. Now, again, in the next video, I'm going to be talking all about our favorite trading strategies and show you proper entry techniques for each one of those. But this is just the idea that so you understand how a trading system gets put together, you need to have something that every single time that this happens, you trade it mechanically. Okay. So anytime, say, for example, the moving averages cross, that's when you're entering a trade. The next thing that you need is a exit criteria. So you need something that actually happened in the charts that require you to exit the trade. So staying on the same theme, let's just say, for example, here that maybe you enter on the cross and maybe say you exit on the cross where it looks like it almost crossed here, but it ended up crossing up right up here. So maybe that's the way that you exit the trade is the moving averages cross over, saying that the trend may be ending. Now, again, on the RSI, let's say that you enter here when it dips below and it comes back in. Maybe the way that you exit the trade is you wait for it to dip above this 70 period where it's overbought. And again, staying on theme here, talking about the Bollinger Bands now, maybe you enter once it comes down into this lower band and you wait for a green candle. Maybe your exit signal is when it either crosses, let's say this orange line, this median line, or it comes up and it touches the other side of the Bollinger Band. Maybe that's your exit criteria. Whatever your exit criteria is, you need to have an exit criteria. Or if you like to use the SGA, which is one of my favorite algorithms that you've heard us talk about on this channel probably, then it makes it really, really easy. When this dark red turns to like light red, maybe that could be your entry criteria. And then you wait until this green turns to light green. So as you can see, a beautiful trade that sets up there. Again, same sort of scenario here. You'd enter right here, which is great. And you'd wait for it to turn over to light green just like that. And that could be your exit signal. Or if you want it as easy as possible, you could just basically trade when this green line turns green, and when it turns red, you exit the trade. And yes, this actually does have an edge. This is the Spiral Guide algorithm. If you'd like to try it, you can go to our website, blueedgefinancial.com/crypto, and you could try it for 30 days. And if you're not happy with it for whatever reason, just let us know. We'll give you all of your money back. Okay, so now you have the fundamental principles of a trading system. Now it's time to put this all together to start building confidence that your trading strategy actually has an edge. So we know the time frame. We either decided if we're going to be scalping or swinging. We've also decided which direction we're going to be trading. We've decided on a risk amount per trade, and we've also determined our exit and our entry criterias. Now, the most important thing is to back test your strategy. And this is really important in building confidence with your strategy. I'm going to show you exactly how to do this. So in TradingView, there's this really cool tool. It's called Bar Replay. You just click on it and you click wherever you want in the chart, for example, and then you can start advancing the bars kind of one at a time here. And you can see if your entry criteria gets triggered, when would you actually enter the trade? And this way you can back test it and you can trade it for yourself. Now, it's recommended. So say, for example, this is green, say we want to start trading it now, then we just wait for the bars to advance, right? And we'd see what happens with the trade. Okay, that's kind of the idea behind back testing, okay? Now, the idea behind this is that you want to take at least 20 trades, and not only does this help you with like executing, but it also helps you with your psychology. So you know, like, how many of these trades should I expect to win? Or how many of these trades should I expect to lose? Or is it common to lose 3 trades in a row back testing the strategy? So 20 is generally a good enough sample size, but the more you do, the more confident you're going to be with your strategy. And this way you'll know if your strategy actually does in fact have an edge. So now it's time for our favorite part, which is putting this all together. And I actually want to show you some of our favorite trading strategies. And I'm sure this is the video that you guys have all been waiting for. So go ahead. It'll be somewhere on the screen. You can click it and you'll be able to watch that video. So go ahead, check that out right now.